Hey guys, in this video, we're going to recap our last Tuesday Night Live, which really was exciting. We had Alyssa Glutz. She's a loan officer in Scottsdale, Arizona. She's also the author of a book called Color My Credit, where she helps people actually improve their credit and credit score. But one of the interesting things, guys, is she thinks that mortgage interest rates are going to drop down in the fours by the first quarter of 2023. All right, so let's dive in.
What I see happening and what I watch a lot of different analysts out there, what I see happening is that we're starting to see a turn right now where I think that the rates will be probably in the high fours, like low fives in that first quarter of 2023. And then I think in 2024 is when we're going to start maybe seeing them back down in the fours again. I believe like right after the first of the year, you're going to start seeing some breaks. We're already seeing a little bit.
Melissa, boy, that was kind of mind-blowing to me, you know? I mean, look, Jay Powell just came out with the press release at the Brookings, Institute and was talking about how the Fed is not pivoting. They're not going to back off, the core PCE inflation rates are still, and they, by the way, they like the PCE better than the CPI. They feel it's a, kind of like a better gauge of where we really are in our economy. And we know that there are three major components, and housing is one of those big major components with core PCE inflation. So, it was interesting in our Tuesday night podcast with our guest being a loan officer, maybe just being hopeful. Maybe we're wrong in our thoughts, but she kind of felt that the Fed would pivot, or at least mortgage interest rates would drop to a point in the fours by the first quarter of 23. What are your thoughts on that?
I respect Alyssa. She's a lender, and we hear it from a lot of lenders locally here. I think they're very optimistic. I think that this is what they hope for. But with all the information we're getting, especially with Jay Powell just having his conversation this week, his press conference, I'm not so confident that that's where rates are going.
I think the big thing is, the big question here is that if they do drop the rates, and here's my kind of thought process, guys, and if you think different, or you agree, drop your comments below. We always love hearing from you. But I think a big part here is that Jay Powell, the Fed, and everybody else on the planet really has, in their opinion, felt that house prices, home pricing have really gotten out of control. And I think we've seen, in a lot of cases, 20, 30% year-over-year increases in some markets where it's just ridiculous, right? And now we have an affordability crisis. So we have to really look at, if we drop those rates, is that really going to improve a market correction that Jay Powell felt that was necessary in, one of his press releases? He said, hey, look, we need a market correction, a market pricing correction in housing. Is that going to be the answer? Is the answer to drop the rates back down again so that, the prices remain high? Or is it their opinion to try and put the pressure on interest rates? At least that will change the affordability of consumers, because their interest rate doesn't directly affect the mortgage rate, but it affects consumer loans like credit card debt, automotive debt, revolving credit types of debt, right? So if those interest rates stay high, it really will deplete a lot of the consumers' cash, and it's going to restrict their ability to buy anyway, in my opinion, regardless of whether mortgage rates drop or not.
Alyssa also mentioned that what she's advising the borrowers to do that she's been working with is they're going to have to restructure their budget. They're going to have to put a budget and have more of housing expense. The monthly payment is going to be factored in. And that's really quite hard when a lot of people right now, some of them are even putting groceries on their credit cards.
You do have to mentally, like I said, people are going to have to shift their thinking into having more of their monthly budget going to housing in general.
Yeah, she's also indicated, that lending requirements are allowing consumers to spend more of their income, their gross income, to qualify for a loan. And, that's kind of scary too, because what a lot of loan officers are saying is, drop off the car loan if you can, drop off these other expenses so that it actually lowers your debt to income ratio so that you can apply for more of a housing cost or a larger portion of your income towards your mortgage payment. The problem with this is once we start to stretch those budgets and take a bigger chunk out of the income that we make to go towards housing related costs, these other life things are going to happen. You're going to need a new car, or you're going to need to spend money on an automobile, or, you may not get those job raises moving forward with the state of the economy that you hope for.
She had also mentioned there are 3 factors that go into purchasing a home. It's credit, income, and assets. And what she is seeing with the income is that people with their job stability, they are jumping around. Some people are losing their jobs, and some people are just not having what they had a few years prior as far as stability with their income.
Are you seeing, out of a lot of the borrowers or the people that are applying for loans, are you seeing a lot of longevity on employment at a specific employer? Are you seeing that there's a lot of jumping around, job jumping?
A lot of jumping around. A lot of jumping around. A lot of shakiness, a lot of people that are held back. They've actually got their credit score up. The CIA, they've got their credit, they've got their income, they've got their assets, but a lot of them, the income piece is really messing them up.
And I think a lot of people are going to realize, and we're starting to see it where, over the last 2 years, there was a lot of jumping around, where, headhunters, employers were recruiting and giving sign-on bonuses for employees to jump ship. So yeah, she indicated that there was a lot less time on the job amongst many of the applicants, but I do think that that's going to stop and slow down, because I think that people are really thinking about their jobs a lot differently. I mean, there's no secret. You listen to the news, Amazon laying off 10,000 plus people, even like DoorDash has laid off 1,200 people, something like that. So I think, people are starting to realize that, hey, I better really start paying attention on my job, because the pressure on the employers, lack of sales, the downward pressure on pricing in general, is causing employers to really take a look at their top line expenses, labor being a huge part of that. And they're starting to assess and address whether they can get it done for less and whether they really need those high paid employees at all. So for that reason, we're starting to see, the employees start to pay attention a little bit more to their job, try and do a little better job, and not this quiet quitting that we've heard in the news about people not really doing their job so well. And the employers are starting to address that.
Alyssa had also mentioned that, even though we're in such a changing market, that this is major opportunity for different types of loans, government loans, for example, FHA, VA, that they may have been bidded out before when putting an offer in, and now they can really go ahead and go after that home that they want.
This is a massive opportunity right now for every veteran and everybody who wanted to go FHA in the last few years and couldn't, because they couldn't compete. Not only could they not compete, they couldn't up with the cash difference to go over the appraised value. They couldn't even get in the door to have to pay more for the house. But right now, veterans, you're getting no down payment. You're getting repairs, paid for. You're getting your closing costs covered. They can even cover some of your old debt, your old bad debt. Look at all of the ability for anybody out there who wanted to use government, FHA or VA financing, that they actually have a way to get in here.
And a lot of this is because the government-backed loans, such as VA and FHA, they have a lot higher safety standard requirement for that home prior to the buyer purchasing it. So as she said, in the last couple of years, there has been so much pressure on buyers to eliminate things like home inspections and requesting repairs. I mean, they were eliminated, and so many cash buyers and conventional buyers, so much money in the market that, these FHA, VA buyers, really, their offers a lot of times weren't even being considered. But, I do want to caution the buyer that's out there that is looking at these types of loan structures, because I always get nervous when people aren't putting much or any money down on the property at all. When we're in this uncertain time, if you're buying right now and we know there's a lot of downward price pressure, if home prices continue to fall and you've put very little money down, if you need to sell, you could be underwater.
And Alyssa did mention some pointers and tips for you buyers out there. So let's have a listen.
The truth is, the scoring models used for mortgages have a two-week time frame of you being able to shop, like get this lender to pull and then this lender can pull, and it would only be considered one hard inquiry. I feel that you should be shopping people. Okay, you should be shopping, especially if you're a first-time home buyer. There are so many little stops all along the way that you want somebody who's going to say, okay, now we're here. Do you want to do this? If you do this, this is what could happen. Okay, but if you do this, this is what could happen. I mean, the last thing you want is just to be trying to direct yourself through your very first home buying process. So find somebody you trust, that you feel that you can be open with, that they're going to communicate, they're going to be available for you. I mean, at night, weekends, whenever it's convenient for you, and that you're really going to be able to learn something from, and you can stay loyal and build a relationship together. You'll get a lot out of that. There is now a resource available to you. If you go to My FICO, pay for the 3B report, and it gives you the 3 reports side by side. It does cost money, but it's the only place you can go where it's not an inquiry, and you get your real deal mortgage scores, your auto scores. You get 28 of the FICO scoring model scores that they actually use for a house, for a car. Because any of the free credit scores you're getting, they don't use them for anything. So it is one of those things where when you see the scores you want to see on My FICO, move forward and have the mortgage lender pull your credit.
Something else that she stressed was the importance of FICO score, right? Credit worthiness for buyers if you are looking to buy a home, if not now, even within the next 12 months. And another, kind of word of caution, as you consumers are out there spending money, really be careful what you're buying. Make sure it's a necessity and that you can pay it off. Because when you get into an environment where you're paying in a revolving debt, with credit cards, and you're paying minimum payments, or you skip a payment, things like that, this is going to hurt your credit score, reduce your debt to income ratio, that when you are ready to buy a home, you may not be able to. And guys, it takes a while to get your credit back. So keep making sure you're making those payments. So Melissa, I won't say that our Tuesday night podcast was controversial between Alyssa and myself, but because we love her, right? She's great. She's a super contributor to our channel. She's really smart and she helps a lot of people. But, guys, we do have a little bit of a difference of opinion. And what I'd like to do is just let's take to some of the comments from Tuesday night's podcast and let's talk about them.
Gina S. commented and believed that rates were going to go up and that the higher rates would push prices down.
And I agree, Gina. I do think that interest rates are going to continue to rise. I mean, maybe they'll flatten out, but I don't think we're going to see 4%. Hey, maybe I'll have a video here in a couple months and tell you how wrong I was. But I do think that, yes, higher mortgage interest rates will correct some of the housing prices, some of the overpriced situations that we have across the country, just as the Fed intends.
And Josh Engine says, seems very risky to me to buy a property banking on rates going down within a couple years.
And I think what Josh is referring to here is a lot of loan officers say, date the rate, but marry the house. And, go ahead and buy the house is what they say. Do a buy down, do an ARM or whatever, get the house. The house prices are going to continue to rise. I hear a lot of people say this, right? And, just pushing and pushing and pushing buyers to make a decision with the hopes that later on they can refinance when those rates come down. And I think one of the things that we really didn't get a clear answer out of Alyssa was, what is the appropriate time to refinance? Is it if the interest rates fall a 0.5% from where you purchased or a full percentage point from where you initially purchased? And what she said at that point was, a lot of people, it's just the psychology. of things that it doesn't really save a whole lot of money necessarily to refinance, depending on how long you intend to stay in the house and also what it is going to cost you to refinance, because there is a cost.
Mike Paulus commented saying buyers are putting away more cash while waiting for prices to drop. I think interest rates will go up another 2% and will stay there for at least a couple of years before things move down at all.
And Jay Powell did reference, Mike, that they would be prepared to do whatever it takes to get inflation down to a 2% level, and continuing to raise interest rates will probably still be in the plans going into 2023. And I think what Mike's saying here, is really important, because buyers, my recommendation to you is, don't give up the hopes on buying a house and then just spend your money saying, I'm just going to buy other things because I'll never buy a house. Bank that money, like Mike is saying here, put it in the bank, because if interest rates do go up and prices come down, the more money that you have to put down on a house is going to help you significantly. And I'll give you an example. Let's say that mortgage interest rates are 7% a year, right? And you save another $20,000 or $30,000 that you can put down on your house. By putting that money into your house or into your mortgage, paying more money down, you're essentially making 7% return on your money. Now, loan officers may caution you that, hey, but once you give that money up, you don't have access to it. And though this is true, but if the money is specifically set aside for housing, in my opinion, it's the financially smart thing to do. And finally, Melissa Lexi said that Alyssa did give some great tips, but Lex wanted to know, what constituted a crash, because the 20% that was referred to in the Tuesday Night Live really was no crash at all. And this is something that we hear a lot. Guys, you are saying, you want to see 40, 50, 60% price decreases in the housing market. And though I would like to say, you get your wish one day, we didn't really see that in 2008. Unless they were significantly distressed properties and things that most people couldn't get loans on. Yes, we may see that kind of price reduction again if foreclosures ever become a major thing in this market. But I think, guys, really a 20% correction would be huge. And, we'd love to know your comments. If you agree, disagree, what's happening in your neighborhood, drop them below.
If you guys like the video, hit the thumbs up and share it with your friends.
And don't forget to subscribe to our channel. Hit that alert bell, guys. It'll let you know every time we upload content just like this. See you next time.
See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.